Well, we're through the Fed, and we've had a day to digest it and think about it, and the markets are nowhere. Apparently, we don't know what to do and what to make of what's going on, but we're going to try to figure it out here and see if the markets really are through whatever consternation struck them over the preceding 4 weeks, or if there is still trouble ahead. This is Macro Money. I'm Ilya Spivak, head of global macro at tastylive. And what we are going to start with here, first and foremost, is, of course, identify what it was that the Fed did and didn't do, what the tone was, why the markets initially reacted the way that they did, and then see if this lack of conviction tells us anything in the aftermath. So let's break this down. We're looking here at the Fed policy statement, and you can see the revisions highlighted on it, and you can very clearly catch it's that second paragraph where all of the action is. Now, much is being made about the changes in QT, the runoff in the Fed's balance sheet, but we'll get there in a second. The meat of what the markets seemingly reacted to is that second paragraph revision. So you'll notice that before, the committee thought that risks to achieving its employment and inflation goals were roughly in balance. Now, uncertainty around the economic outlook has increased, and the committee is attentive to the risks to both sides of the mandate. Now, ostensibly, this is exactly what the markets wanted to hear. They wanted to feel seen. They wanted for the markets sell-off to be noticed by policy officials. And the conversation that was being had from the White House against the backdrop of the sell-off was, yeah, we really don't care. This is fine. The economy needs to adjust and, quote-unquote, detox. It's unclear what it needs to detox from, but the message was, look, this is not anything to be concerned about. The underlying economy is healthy. This is just a lot of new policy happening all at once. The markets will adjust. What the markets saw was, as we discussed earlier on the show this week, not so much that the policy was untoward. They knew what the policy direction was going to be as early as November and maybe even before. But certainly once it was clear that it would be a Trump administration that would be taking office in 2025, the markets very clearly knew that there would be tariffs, that there would be cuts to fiscal spending, that those cuts to spending might be balanced by, at the very least, making the first Trump term's tax cuts permanent. And so there would be a generally understood policy trajectory. It's not until survey data on business confidence and consumer confidence, in particular the S&P Global PMI surveys in early February, that began to show that the implementation of the policies is starting to impact confidence. Not the direction, but the seemingly volatile implementation of the policy that's starting to impact sentiment. And what that sentiment is doing is it's pushing people to withhold spending, pushing businesses to withhold investment, and that is significantly eroding confidence and undermining activity, especially in the service sector. And so what the markets wanted as they reacted to this over the past 4 weeks was some sort of a reaction function from officials, where the markets fall, officials go, oh, well, that's not good. Let's calibrate our approach. Not necessarily, again, in terms of direction of policy, but implementation, or at least communication with the markets. And the message from the administration was, everything is fine, we don't need to calibrate, moving on. The markets then turn to the Fed and say, well, surely if something were to go wrong in this implementation, you would backstop us with lower rates by cutting borrowing costs sooner. And if you're going to do that, we're going to need for you to signal that you're seeing what we're seeing here. And this passage seems to indicate exactly that. Now, as far as the summary of economic projections, the other big sort of numerical forecasting tool here, we can see the Fed lowers its GDP expectations, which, again, seem to acknowledge the market's concerns. They also increase inflation expectations, which seem to acknowledge consumers' concerns. The latest survey on consumer confidence from the University of Michigan put one-year inflation expectations back to 4.9%, which is the highest since the second half of 2022, just as the Fed was starting to really have impact on bringing inflation lower, having, of course, initiated a blistering rate hike cycle in March of that year. So the Fed is seemingly saying to the markets here, okay, we can see that there is a risk that growth is going to be weaker, and we're going to acknowledge that. We can see that there is a risk that inflation is going to be higher, and we're going to acknowledge that. This pulls policy in different directions, so we're not going to change course on the actual expectations for Fed funds. And of course, as Fed Chair Powell began to speak at the press conference after the meeting, the caveat there is we're not going to adjust it for now. And this probably gave the markets some confidence in being seen as well. And we'll go through what Powell said here. It's been nicely categorized by the fine folks at Forex Live. Had tipped to them. Here are the highlights. So on rates, I mean, the clear sort of bottom line here is the Fed does not feel that they are in a hurry to move now. And we can see that it's not so much that they're reluctant. They're saying they can move in either direction. It's that they are waiting for clarity, and they don't think that waiting is a high-cost proposition. They feel confident that they don't need to be in a hurry. They can wait. And of course, they're acknowledging here that if the Fed's goals need to be balanced against each other, that is to say, weaker growth, higher inflation, that would be difficult, but they're not currently seeing that in practice. On the spiciest topic of the bunch, tariffs and inflation, the Fed, of course, acknowledges that tariffs tend to bring down growth and tend to bring inflation up. Of course, the forecasts reflect exactly that. But what they're saying is that it's too soon to say if it will be appropriate to look through these effects. And of course, we've heard these comments from the administration saying that what a tariff is a one-time price adjustment. And that one-time price adjustment will work its way through the economy once it's made, and that's it. Businesses will, as a one-off, adjust to a new level, and on we go. That's not necessarily wrong or right. It's a cogent theory, but when you put tariffs on input goods, for example, like aluminum and steel, that other industries rely on, there can be vast ripple effects, and those ripple effects can be sticky. So, for example, if you are a maker of steel and there are tariffs on steel, well, then you're happy because the price of steel from your imported competition has gone up, and that opens more markets for you to sell steel, at least domestically. But if you are a buyer of steel, let's say you make nails, let's say you make appliances, cars. If you are a buyer of steel, then you now face a higher input cost structure. And that means that you're, assuming you're passing that on, of course, as most businesses would be, at least to some extent, now you have a general rise in the price level for whatever it is that you're selling, for which steel is an input. And everybody that buys that thing from you now has their cost structure go up. So even though you might not be applying a tariff directly, let's say to appliances, in applying one to steel, you are. To appliances and cars and home fixtures and nails and whatever else. So it's unclear what ultimately the net effects look like, and that's exactly what the Fed is saying here. A telling quote here is Powell says, "I'm not dismissing that short-term inflation expectations are rising, but long-term expectations are still anchored, and that's what we're going to watch." So wait-and-see mode yet. But again, an acknowledgement of the source of the market's worry. On the economic outlook, again, acknowledgement. Sentiment has fallen off, but the economy is healthy. And this seems to be the real key going forward here. If soft data becomes hard data, we will know very quickly. The upshot being, if the pain and mayhem that now appears in this sentiment data, like PMIs, like consumer confidence data, starts to show up in employment and inflation and so forth, well, then the Fed will be ready to pull the trigger on rate cuts without delay. So we see all of this, and the bit on the balance sheet is interesting because the Fed says that what got them thinking about reducing the runoff in the balance sheet wasn't a particular desire to ease policy. It was flows in and out of the Treasury general account, which reminds us that when the Fed makes money on these securities, it puts the proceeds back into Treasury because the Fed isn't financed by taxpayer money. It finances itself through its own operations. And essentially what Powell is saying here is that they would like less turnover in their Treasury security holdings coming in and out of the Treasury general account because the markets are uncertain and bond prices are jumping all over the place. So the Fed doesn't want basically their P&L with the Treasury to be volatile. So they are going to move at a pace that's slower. We'll notice that what the Fed doesn't do here is make any changes to its pacing for mortgage-backed and agency debt, just the Treasury side of things. And this probably speaks to their perspective that monetary policy expectations are likely to remain volatile. So the market ostensibly feels seen and gets that bit from the Fed that it wants to hear, that the Fed is mindful and that the Fed sees what they see. And the response is encouraging. Stocks go up. The upshot is that whatever the Fed said was dovish. Yields come in. The yen, a creature of yields, mostly, goes up, as it tends to do when yields decline. Bitcoin confirms the risk on tone. Gold, interestingly, doesn't make a big move, but it had been rallying going into this, so perhaps it just ran out of immediate conviction, having already gone up a lot. But one would think that gold would be better supported in an environment where you have this kind of a situation. And the euro, interestingly, is down, but look under the surface and it's down much less than it had been earlier. The decline going into the Fed was almost 0.8%, and ultimately the euro finishes down only 0.3%, and all of that reclaiming of lost ground comes after the Fed. So the dollar weakens on net. Now, of course, the markets are concerned and have this need for acknowledgement because there has, in fact, been a downturn in the economic data that is worrying. And this is the Atlanta Fed's GDP Now tracker for the first quarter GDP number. What this is a nowcast, so it takes incoming economic data as it appears, dumps it into the model, and the further you go in time, the closer you get to the actual number, the more data and the more relevant inputs you have, so the closer the forecast is to what the actual number is likely to be. Whether or not the economy actually shrinks at an annualized rate of 2% in the first quarter ultimately is not what's important here. There's no way to know that ahead of time, and although that looks dramatic, who's to say? What's important is the direction of travel for the model, because what it tells us is the tone of the incoming data that's been dumped into it. And clearly, everything that's been coming out, basically since late February, has been painting a very grim picture, which is why the model looks the way it does. So the markets are concerned because, indeed, the data is telling them to be concerned. And, of course, the first piece of this data has been the S&P Global PMI numbers that show over the course of January and February a steep drop in the manufacturing in the service sector, even as manufacturing claws back a little bit. Commentary from S&P Global in doing these surveys has been, it is uncertainty about fiscal policy and trade policy in particular that's driving negativity in the services sector, which is interesting, of course, because trade policy mainly concerns the goods side of things. So this is a very pure sentiment sort of indicator where the economy's largest sector is more concerned with the optics of the policy and how it's being implemented and what they're extrapolating from the management style than really from those things hitting services directly because the price of this or that input has gone up because of a tariff. So that's, of course, very telling of general sentiment in the business community. For the manufacturing side, there has been a little bit of a move higher. We're north of the 50 boom-bust level where the sector is expanding, and in fact, it's now expanding at a faster rate than is than is services or the overall composite, which tends to follow overall services because, of course, it's a much bigger sector of the economy than manufacturing is. But the commentary on that is this is mainly front-running of the tariffs. So stocking up on things before the price goes up. And that's where you get all this extra manufacturing activity, which makes the upswell necessarily a temporary thing. Moreover, this doesn't just scream that there's a problem in the U.S., but when we look at the drivers of global GDP growth, we of course see that the U.S. is the biggest overall piece at 26%, but moreover, the entire pie is 58% just three economies, the U.S., the Eurozone, and China. And those are the main drivers of demand. Most of the rest of the world, 42%, are vendors to the large three. So obviously in the U.S., we're thinking Canada, Mexico. In the Eurozone, Central Europe, Nordic Europe. In China, we're thinking Australia, New Zealand, the commodity producers of South America and Southeast Asia and Africa. So a lot of what's there in that 42% needs demand from China, the Eurozone, or the US in order to have contributing demand of their own. And so this is really why the US slowdown is such a problem. Going all the way back to the middle of last year, the Eurozone and China are already on a slowing path. It's the US that's holding up global growth. And the first 2 months of this year, what you get is the very wrong kind of convergence, weakening US activity coming down to the standstill-like setting that we see in Europe and in China. How you don't get a global recession in this environment seems difficult to imagine. In fact, we can see that all through last year, overall global PMI numbers from about mid-year are slowing, which reflects exactly this. The U.S. is powering higher, but it isn't pulling the rest of the world along because the other two engines are off, and what is actually getting powered in the U.S. is the service sector, which is mainly serviced by domestic firms. Imports, exports, where U.S. demand might extend to other countries because they're selling to a robust U.S. consumer, that's the goods side mainly. And that's why the overall global total has been moving ever closer to ever slower settings over the course of basically the second half of last year going into this year. And of course, the situation has only become exacerbated here at the start of the year with the U.S. looking weaker. First thing Monday, there's an opportunity for this trend to be reasserted because we're going to get the March updates of these PMIs. And of course, we're going to be looking at the U.S. numbers most closely. The expectations here already that we're going to get weakening to near standstill on the composite as services contract. The numbers out of the UK looking like maybe they'll be a little bit warmer. The numbers out of the Eurozone looking like they're going to be, again, flat. We're not going to get updates from China until later in the week and the following week. And if you look at what's going on in Australia and Japan, it's about a scratch there. So the real issue, of course, the U.S. numbers, and that we're expecting this slowdown. Moreover, U.S. economic data has been tending to disappoint relative to expectations, eyeing this Citigroup data. So we could get a reminder of exactly the risk of recession that the markets have been so worried about as soon as Monday. And the real question will be, do the markets shrug that off because it's not, quote unquote, hard data? Or do we finally see this consolidation post-Fed resolve? Is it going to resolve to lower stocks? Any which way it go, it seems likely to resolve to higher bonds and a weaker dollar as more easing enters into the longer end of the forecast. And that is macro money for today and for this week. We are here Monday through Thursday, right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. Macro money will be back next week, as it always is, Monday through Thursday. I'm likewise on with Chris for Futures Power Hour Mondays and Fridays. That's coming up tomorrow. On with Victor Jones for The Price of Truth on Tuesdays. On with Victor and Tom for First Call on Sundays. Check that out at the start of the week. Writing for the News and Insights portion of tastylive.com. Commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money's back next week. Take care.